I'm Howie Lim. This is Money Hacks by the Business Times. Fixed income is increasingly viewed as a core portfolio allocation for income, diversification, and capital appreciation. It's still an option for investors to earn a yield rather than opt for a full flight to safety by holding cash, which many seem to be doing. Money market balances hit almost $12 trillion by end 2025, we hear, and many are avoiding durations. Bonds also have a strategic role to play in today's macroeconomic climate. What are the advantages of credit in the current interest rate environment? And how can investors uncover overlooked opportunities and mouse traps in the fixed income space? Joining us to discuss, Erik Keller, Client Portfolio Manager at Robeco.
Yeah, thank you.
And Kylie So, Client Portfolio Manager, Managing Director, Fullerton Fund Management.
Okay, thank you for having me.
We're talking about fixed income, but with bond yields higher than they've been in years, how can the average retail investor think about reintroducing fixed income into, say, a typically equity-heavy personal portfolio?
Yes, so fixed income is attractive again because investors are once more being paid a more meaningful income to take bond risk. That means bond can do more of the job that they were always meant to do, provide income, help smooth return, and act resilient alongside equity. I think for a retail investor, the key is not to think about fixed income as all or nothing, but to consider having some fixed income in your portfolio. So let's say if you have been very heavily tilted towards equity, this could be a good environment for you to rebuild exposure in fixed income in stages.
Yeah, if you look at the yield levels, we are really at the highest level since the last 20 years. So I think it's a very good starting point. Ultimately, within bond investing, yields are your driver of total returns. That's the most reliable indicator. And I think with the current levels, you can stomach quite some volatility markets. And I think that is very different from, I guess a lot of investors still have 2022 on their minds. All of a sudden, central banks had to hike rates and we saw a big sell-off in fixed income markets. The difference is at that point in time, the starting yields were very low coming out of COVID. So there was very little cushion for yield rises. And I think that is really very different now. You know, you like to invest in bonds for income. With yield at current levels, we do definitely see that they are being attractive of creating a very stable income in portfolios. So I think from that angle, yeah, it makes also a lot of sense for equity investors to start looking at fixed income again.
But it seems like many are still wary of bonds because of the volatility over the last few years and such. So how can credit strategies truly act as a diversifier and protect against these downturns in the markets?
Yeah, within credit markets, so when you start investing in corporate debt, you want to achieve an additional yield, additional income over treasuries. Yeah, we do see a lot of opportunities. So I think there's more dispersion in credit markets. Companies are digesting AI disruption or AI adoption. We have the energy shocks. We do see more differences between regions, between industries, especially for corporate bond investors. That also opens up a lot of opportunities to add additional yield or return on top of the return coming from treasuries. We also think that in the current environment, we would favor more short-dated, high-quality corporate debt. So that is actually a part of the market that we think is most resilient in different environments. And that will be a nice entry point for especially equity-heavy investors.
When you say short-dated, how short?
Yeah, so typically what we like is between the 3 to 7 year point. I think interest rate duration-wise, we more look at 3 to 4 years. Longer-dated fixed income, it might give you a little bit of additional yield, but of a lot of potential volatility. I think one of the sources of volatility in markets so far has been interest rate volatility also this year. And it's important to manage that kind of volatility and really focus on more shorter dated bonds, so up to the 7 year point, but with controlled volatility.
Yeah, I think it's interesting that you mentioned credit strategy. So I think one important distinction is that not all bond strategies behave the same way. So for example, a flexible credit strategy or a well-constructed credit strategy, you're not relying on just one source of return. You can have income, carry, you can have duration, you can have sector country allocation, you can have issuer selection, all working together for you. So what happens is in a risk-off environment, certain return drivers will support performance. In other risk-on environment, other drivers are better positioned to capture the upside performance. So maybe diversification today is less assuming bonds will always rally, but more about owning the right mix of bonds.
If someone has a longer time horizon, say 10 plus years, does it still make sense to allocate maybe some to fixed income? Because wouldn't they just want to stick primarily to high growth?
Even with a long horizon, fixed income will still be meaningful. So time horizon essentially tell you how long you can invest, but it doesn't eliminate the need for diversification and for income. So bonds play an important role because it can reduce the severity of a drawdown, which makes it easier for investors like you and I to stay invested through very choppy and difficult equity market where you're very tempted to dispose or sell your equity investment, often at the market low or at the worst point. Today's bond yields are much more meaningful than when yields were near zero. So fixed income can contribute more to building your long-term wealth. So for long-term investors, I think the question is not so much bond versus equity, but how to combine the two in a way that helps you to stick through a market cycle.
Because not all credit is created equal. But there actually we see positive total returns over 1 to 2 year horizons in different scenarios. And even if you have a fierce stagflation shock, you could even consider that at some point markets are getting more concerned about the growth impact. And then also I would say fixed income makes sense, but again, avoid the more longer dated exposure.
Help us out with a 101, if you will, for a beginner investor looking into fixed income. What are the key differences between, say, fundamental credit strategy versus a quantitatively managed one? Already, I don't even know what that means. How do they impact risk and return?
Yeah, that's quite a mouthful. So at Fullerton, our process is fundamental based. We look at the top-down macro environment of how the company will perform, whether it's conducive for the company to thrive. Combine that with bottom-up credit research. So our analysts form a long-term fundamental credit opinion looking out 12 to 18 months. So it's less important how the company fared today, but how the company will develop in 12 to 18 months' time. So quantitative strategy, in contrast, is slightly different. It's very heavily reliant on models, data, and also market signals. It's hard to say which is inherently better, but they tend to behave differently. So fundamental strategy is better at avoiding hidden blow-up, peep holes, identifying mispriced bonds, so a bit more judgment-based. Quantitative strategy is more about like consistency and broad diversification.
I want to talk about the current interest rate landscape in a bit and what it'll do to reliable income. And can higher yield ever be safe? More in a moment.
Good conversations start with the right questions. This season, those questions are about us. The people, the policies, the forces shaping all of us. Lens on Singapore with Clarissa Montero. Back in May. Powered by the journalism of the Business Times. On YouTube and wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
Welcome back. Erik, what's the most overlooked or misunderstood opportunities in the global credit market now that Joe Regular might not hear about, that's not covered in the mainstream news as well?
That's an interesting one. What is overlooked is really going truly global. But we found that a lot of investors are very US focused. 60-70% exposure to the US market.
Even now, with dollar debasement and such?
Yeah, I think overall it depends a little bit on the portfolio, obviously, but you still see a very strong focus on that, on the fixed income side. You have to be truly global and look beyond the US, also into European and emerging markets. And we found a lot of good opportunities in those markets. European banks, think about utilities or telco companies in Latin America, mining companies. We think in any case, also emerging markets is a quite diverse opportunity set. Also offers a lot of interesting opportunities for active managers. It's not that we say don't invest in the US, but we think a lot of investors are forgetting that, Europe and to a lesser extent, perhaps emerging markets is a bit of an overlooked part of the world. And we think there we found a lot of good opportunities where we've been able to do better than having a pure US exposure. Also because you see this more divergent globally, right? You see differences in central bank policies. You see differences in economic developments between regions, different industry trends. So how is AI impacting different companies in the US versus Europe or emerging markets. There you will see also more dispersion in valuations of companies in Europe, US, and emerging markets. So we think it will continue to be very important to have this global mindset and really also focus on European and emerging market opportunities.
Yeah, but every time we hear high yield, we think risky, right? Is that the biggest misconception about high yield bonds, you think? Or what is the biggest misconception?
No,
I mean, they have a role to play.
Yeah, absolutely. And I think we absolutely think they have a role to play, but not all high yield is created equal. So if you look at the high yield market, you have, let's say, the lower quality segment of the market. So CCC rated debt. There you see over a cycle, 5-year cycle, that at least 25% of the market defaults. So it's a much more riskier market. You might optically get higher yields, but to some extent we call it phantom yield. So it's yield that you cannot realize if a company destructures or defaults.
Yeah.
But then again, if you look at the double B, so the higher rated segment of the high yield market, there actually over a 5-year cycle, the default rate is less than 1%. So it's significantly less risky. So we think actually in the high yield market, the double B segment still offers a very nice yield, but not with the risk that you see in the lower quality parts of the market.
All right, we have to talk about this now, the current interest rate landscape. We're all sitting on the edge of our seats wondering what the Fed is going to do. What are our do's and don'ts for retail investors, especially when it comes to constructing that fixed income portion of our portfolio?
I think really manage your duration risk. So we think that, again, we like to focus more on shorter dated maturities, so up to the 5-7 year parts.
That's difficult for people to accept, Erik, because they always think longer means less risk.
Yeah. But that's actually not what we see in practice. So we see through the cycle that, and I think I would argue that with all the concerns out here, credit being risky, but actually most of the risk is, there is more risk in government debt, right? If you look at debt levels in the US, in Japan, in France, in the UK. So what we expect is more upward pressure on longer term rates and more volatility in longer term rates because of more fiscal spending and markets getting concerned about how sustainable these fiscal deficits will be. Look at credit risk. So if you invest in corporate debt, focus on investment grade part of the market. And if you invest in high yield, focus on the double B space, but not go down the quality spectrum.
C.
Yeah, because in the end, as a fixed income investor, you want to sleep well at night and don't be concerned about defaults in your portfolio.
All right, give it to us straight. Where are the overlooked opportunities?
Often the most boring credit is probably the best because they are steady, they pay you the regular coupon, they stay out the headlines, they're fundamentally sound and valuations are fair. Yes, the AAAs, the investment grade quality, those that give you slow and steady returns that broadly are not in the financial news or provide the highest advertised yields. Focus on whether the risk is being mispriced. That means asking a very simple question before you invest. So am I paid enough for taking the risk? That mindset alone, I think, will help you to avoid a lot of mistakes and find better long-term opportunities. Speaking from personal experience, where I actually pick up a lot of financial knowledge before I started my career would be, I think, Wall Street Journal. In my opinion, is the best source because they explain to you what's the meaning of a DAF, what's the meaning of to be hawkish. And the next one, I would say Financial Times, although I think the level of knowledge is slightly higher versus Wall Street Journal. And for the younger audience, I would say listen to a lot of podcasts. Business Times, the podcasts provide very interesting bite-sized financial advice or literacy that you can pick up on your way to work, back from work, getting ready for work. These are quite a few avenues that would be very
Thanks
useful.
for the plug, Kylie.
And maybe lastly is that you could also seek professional advice. So you can reach out to a financial advisor, go through a fixed income, equity, multi-asset product that's available widely within Singapore.
Thanks for spending time with us.
Thank you for having me.
Absolutely, yeah.
Erik Keller, Client Portfolio Manager at Robeco, and also Kylie So, Client Portfolio Manager and Managing Director, Fullerton Fund Management. This has been Money Hacks by the Business Times. I'm Howie Lim.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.